Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 28. As always, joined by the three amigos. We got Rich Diaz, the Tom Brady of macro with Acorn Macro Consulting. He's got the bright orange shirt on today, and we got Keith dressed up for the occasion. Keith Dicker with IceCap Asset Management. Welcome back to the show, gentlemen. A little bit of housekeeping news here. I know a lot of you guys have been emailing me, bombarding for tickets to the live Loonie Hour event. The tickets, as of this release now, are available, so you can check out any of our Twitter accounts. Really, anywhere on social media, it's going to be posted. It's an Eventbrite page. $30 a ticket. It's basically going to be at the Sheraton Wall Center in downtown Vancouver. We're going to be doing a live podcast. There's going to be booze, appetizers. It'll be a good time. We'll do some handshaking, and to get some pictures with Keith, everyone's favorite boomer there. So it should be a good time. So obviously, check out our social feeds. That's where the link to the tickets will be posted. And last but not least, all we ask is that you share this podcast with at least one friend or person. We don't have advertising as of right now, but let's get into the show. Theme of this podcast for the last, 6-7 months we've been running this has been inflation, and still going, still not transitory, at least not yet. Canada's CPI inflation, I don't even know what we're hitting now. It was 6 point something. Anyways, it was a 30-year high. That's all you really need to know. It was a 30-year high. There's talks about Canada. Apparently Stats Canada is adding used car prices to the inflation data. So they're saying we should hit probably 8% year over year inflation for next month once those used car prices are added into the basket. So, Rich, I don't know if you want to break down the inflation numbers for us. Again, you guys might be getting sick of this, but it's a story that doesn't seem to be going away. So let's touch on it briefly.
Yeah. Hi. Let's do it. I think until it breaks and we can just change the subject, I think it's important to inform people. I think it's also to remind everybody that we were told it was transitory. Let's keep hammering that one home. All right. So inflation, headline inflation was 6.66, the devil's mark, versus expectations of 5.7, which I thought was interesting, actually. Often what I look at is sort of what the consensus estimates are versus the actual, and the fact that there was such a big dislocation in that, I think is really sort of telling about where people's views are. Some people call that the inflation surprise or data surprise. So that's something I was looking at. Things that stood out for me were goods inflation, which was at 9%. Not to beat a dead horse, but just imagine what it would be like if we were importing energy rather than exporting energy. I think that's something really important to remember. Food, which people, if I remember correctly, still eat. And that's really kind of an interesting one because it's just such an important part of the sort of the lower your income and your asset. Basically, the poorer you are, the more you spend on food. And that just continues to rise. We're at like 8%. So that's just continue. And that's the reason I'm bringing that up is because, for a long time, for most of 2020 and 2021, it was actually quite stable, below 4. And now it's gone basically vertical. Something else that's gone vertical is housing, furnishing. So I guess once people have bought their houses and now they're trying to fill them up with stuff. So maybe that's why, but that's at 10, 15 year high, etc.
I just got a new couch. So my bad.
You've contributed to. Another thing I think that's gone vertical, but I think is probably a good thing, is recreation, education, and literature and books and stuff like that. So hopefully people are getting back out there, stripping off those masks and reconnecting with the environment. Unacceptable view. Reconnecting with the nature and stuff. So that was pretty good. The thing that I wanted to, the two last points, just so I don't draw Keith's ire, which is keep an eye on shelter. Shelter continues to ratchet higher and higher. Shelter is the largest component of the CPI basket. It's 39% of core, so just keep that in mind. And we're at 6.8 now, so that's crazy. Whoa. And then go ahead.
Well, I was going to add to that as well. I think Canada, I think, tracks their housing inflation a little bit different than the US. So they actually factor in basically your mortgage payment factors into that, right? So when you have rising interest rate environment here, your debt servicing costs increase, which basically means your housing inflation increases. So that's kind of a little caveat there that people should be aware of.
Yeah, but the other thing house prices is that you're wearing
house prices hypothetically. I mean, we're seeing it right now in the suburbs, could be coming off a little bit, whatever, 5, 6, 7, 10%. But because mortgage rates are going up, housing inflation thus is increasing. So
totally agree. But that was the central theme of mine. It's not transitory narrative, which I think is really important that people remember. It's just such a large component of people's baskets, rich, poor. I mean, it's just what people spend on housing. Seems natural. It is natural. And so that's why it's just, until something happens to that number, we're going to be dealing with above average and above target inflation for a long time. And the final piece, which I think is really interesting, and maybe we'll touch on it later on in the podcast, Steve, which is the producer price index, which is what I use to sort of, I don't like models. People who work with me know I think they're silly and you get married to them. But the little sort of indicator that I've built for myself tracks core PPI, which is producer price index that strip out energy. And it's actually showing that we might have reached sort of, if not next month and the month after, but we're starting to reach sort of the peak in the energy impulse in core consumer basket. And that's sort of, I think that's a really sort of interesting point, right? As the Bank of Canada is hiking, which Keith, I'm sure will touch on, we're about to reach peak inflation impulse in Canada. So
I have actually on that. I made a Twitter bet. I think I wagered $500 to this man's charity of choice. It says winner has to donate that, or loser has to send it to a charity or whatever. But that basically I said that inflation would peak in Canada by the end of Q2. That seems to be obviously somewhat of the consensus, but I think a lot of people seem to be also missing that. I'd like to clarify here that the Loonie Hour has been correct since we started the show. I don't know what it's been now. Obviously, we're on 27 episodes, but we've been saying for 27 episodes that it's
28.
28? I don't know. Anyways, it's not transitory. It's not transitory, but we do think from a rate of change perspective, right? So we talked about next month, you're going to have inflation hitting 8%, and maybe we get 8.5%, and then you're going to start to see that rolling over where it goes from 8.5 to 7.5 to 6 to 5. Inflation will probably stay elevated above, the BOC's 2%, but you're going to see it coming off these headline screamers where everyone's freaking out and panicking. I think you're going to see those numbers obviously start to ease up. But Keith, would love to get your thoughts on what's going on here.
I was originally, how's my sound today, guys? I know last week it was a little inferior.
Yeah, people are really not happy. The boomer and technology, they don't mix too well, but we're working on it. So I think you're good.
Yeah, I'm good to go here. Okay. Let's see. So when the inflation story first broke out, I was in the transitory camp, and the reason for that, or I should say, I assigned a higher probability of being in that environment than as full-blown hyperinflation, which is what we're getting into. And the reason for that was because it was my expectation that global supply chains will get back online. The COVID shutdowns were cluing up, finishing up, things would get back to work and stuff like that. That was the assumption. That assumption is wrong because obviously, Shanghai is shut down, and that is probably one of the biggest stories out there right now from an economic perspective is going to have a huge impact. Obviously, the war in Russia and Ukraine, that is having impact, especially for Europe, which continue, by the way. So I think somebody was asking what my target price was for euro currency, and it's zero. So I'd like to be, I think it just breaks up. I really don't think it can continue. And we'll go into more details on that in another episode. But anyway,
That's
just
not
to be
imminent,
clear.
by the way, but I think Keith's long-term view is zero.
His
Yeah,
long-term
so-
goal is to break up the euro.
Yeah, that's my goal. I have lots of friends in the Eurozone, by the way, and they would not want it to go to zero.
No, I'm kidding.
However, but this morning, for example, to give you an idea, I tweeted it out. Well, this is Thursday, right, for us recording it. So the ECB, one of the lads at the ECB, he announced that, I forget what the words were. I can't remember his words were exactly, but something to the effect that we're going to try to raise rates to 0%. Think about that. Raise rates so they hit zero. Of course, it means you're already negative to do that, right? No one else in the world can do that, by the way. That's why Europe is so awesome when it comes to banking. They can do things not even the Americans can do at the Fed. Again, raising rates so it gets to 0%.
I can give you the verbiage. The ECB could lift policy rates above zero before the end of the year, unless the Eurozone economy suffers a severe shock, and it might have to even deploy, quote, restrictive policy to target surging prices under control. Governing Council member Pierre Wunsch said.
Yeah, Pierre is just blowing it out right now. So but think about it. So the ECB, so the Bank of Canada, we're talking a second, like they're supposedly the market is saying they're going to raise rates by 2% or 200 basis points over the next 8 months. I don't think that's ever been achieved before. You know, the Americans are raising rates, the Brits are raising rates, the Aussies, the Kiwis, you name it. And here are the Europeans. They're saying, you know what, we might raise rates by year end. Like they're not even close to the ballpark. Anyway, that's one of the big things. So back to the inflation story again. You know, obviously this transitory term that they use, and granted, central bankers, they have to say that, right? They couldn't come out on day one and say, yeah, the house is on fire, run. You know, they can't do that, of course. So they try to, you know, walk into a trot and then a canter and then a gallop. I think I got those right. So I've been introduced to the riding world recently, and I'm just learning the right terms.
It's nice being a billionaire, eh? Your
mansion.
mansion.
Yeah. Giddy up. But the big thing is, I made the assumption that we would get back on track for everything. And that's clearly not happening. So, you know, Rich mentioned that, hey, maybe we reached peak inflation now this year. Steve has made a bet, you know, for Q2, see the high number, just get, you know, here's a pitch, get Acorn Macro Consulting to calculate the number for you, and you might win, right? However, I think we're headed for something else here. And probably the most significant event of this past week that really caught my attention, and all the guys I chat with, especially the European guys, these guys were just like blowing up with laughter and then just cringing at the same time. But, you know, it was like after a 20-minute rambling speech about nothing, the most powerful man in the world shook hands with an invisible man. So this week, President Biden did this like speech. It was incoherent, and he turns around and he's trying to shake, and there's no one there. And this is the leader of the free world, supposedly. And that's my point here is that, so, you know, we know the numbers. He had 85 million votes for him at the last election. That's 20 million more than Obama had back in 2012, which at that time shattered all records. I know you got, you know, population growth and all that stuff, but the votes that went to Biden in the last election, like it was just astonishing how many votes this guy achieved. And now he's, you know, people are mocking him all over the world. Even CNN, MSNBC, they're starting to turn the other cheek as well. Harris is not a candidate to step up either. So that there's clearly other decision makers behind the scenes. You know, they're pulling the strings on a lot of things here. However, if we continue on this current trajectory, there's a very low probability of Democrats taking back the House or the Senate in the fall. The only way they can stand a chance is if somehow the White House is able to solve some kind of major crisis out there. So whether they do increase the war rhetoric and they get involved and, they blame the Russians and Putin for it, or, the economy crashes and then they're able to rescue it very quickly. But I'm just letting everyone know that do not underestimate the weakness and the lack of popularity right now down in the U.S. and at the White House as an environment coming up where nothing will happen. I'm just strongly suggesting something is going to happen. And again, I think it could be on the geopolitical side. They got a pretty big stick. They can poke someone if they want to. Or the economic side that we talked about before. Raising rates isn't going to crush inflation anywhere. You got to crush the economy, crush the demand side, then that will bring it back under. But that's the initial thoughts on the inflation, where we're going.
Yeah, no, I mean, it's, I think I'd like to clarify a few things as well, just on our part. So, I mean, yeah, it is kind of funny because people are like, yeah, it's just this whole inflation thing. It seems like it's a kind of a one-sided trade at this point. Like we've been talking about it. We've, for the most part, have not really been in the transitory camp. But if you go back to like what, Rich? I mean, you tell me. Like if you go back to like October, November of 2021, there getting towards the year end, I think most people in their models are probably saying, oh, okay, well, inflation from rate of change perspective probably would have peaked out very early Q1. But then you throw on all of a sudden you throw in a war and with in Ukraine, and then you throw in locking down 3/4 of China. All of a sudden that you can't model everything perfectly.
So, I mean, that's true and that's not true. I'm going to pump my own tires here for a minute, if I may, which is I wrote a note in April of 2021, and in my head, inflation was going to get to 5% without even breaking a sweat. That's global headline inflation. So I think there's some you get raked a little bit over the coals, which I think is a little unfair, because I think you put yourself out there, and I think anyone who puts themselves out there and tries to learn and challenge and discuss, I think you're always going to make some mistakes. But I think the thing that you've gotten right and we've gotten right is that policymakers, it was a profound miscalculation, and I feel like it's really kind of Monday morning quarterbacking that everybody's now on the inflation kick after all these months, when July 2021, October 2021, the BOC themselves were telling us that inflation was still not going to be an issue. And so I think, for people with, not to be too much, not to be too much of an arrogant prick, but the point that, people like me who were ridiculed, frankly, for arguing that, 10% of GDP in deficit spending and, $400 billion in liquidity, well, maybe that might lead to increased prices or housing booms or this or that. And I think it's in a way, I think it's really kind of rich that people are saying, oh, well, you've got it wrong now. I mean, that's just the nature of the beast. That's just sort of the job that we've chosen to do. And I'm happy to take those slings and arrows. I think the other thing that I think is really important, just relating to the political issue that Biden is dealing with in the US, and then I think that Justin Trudeau is probably dealing with here at home, is that I submit to you that politicians and politics are lagging indicators, not leading indicators. And so I think that's and they've made that very clear over the history of time and humanity. And so in a weird way, I think the fact that the politicians are obsessing and talking, and that it's become the political kind of bête noire below the border and above the border, I think actually speaks to the fact that we've probably seen the last of it. And then whether it's math through base effects, or because supply chains, despite what's going on in Shanghai, are slowly thawing, I think that, yeah, okay, so we hit 8 and 9, but what matters is sort of where, if we stay there and how long, not, everyone knows that those numbers are bogus anyway. I mean, I've tweeted it today. Someone's like, are you kidding me? Food inflation, 7%. It's got to be way higher. I agree with you. But so that's why I think in general, we should be very, very wary of wary. Fuck, I always screw that up. But anyways, we should be very careful of using politicians as leading indicators when they follow the mob, they don't lead it. And so I think that, just back to your original point, Steve, I think we've done we're going to get stuff wrong here. I've gotten stuff wrong. Basic materials trade is still the one that got away, but in general, I think we've nailed that. And I think it's right for us to now question if it's sustainable that inflation stays at 8, 9, 10%.
Speaking of politicians following, not leading, just was, as soon as you said that, it made me think. We had Justin Trudeau out this week saying that in multiple press conferences saying that foreigners were driving up our housing stock, so we had to get rid of them, and that population growth might have been growing in excess of our ability to add new housing supply, all of which everybody in Canada has been well aware of for the last 4, 5, 6 years. So now, obviously, because he's under threat here, obviously, complete 180. Which, it's these guys will say whatever they need to say. It's the same like the Bank of Canada, right? Like, oh, we're so tough and we are going to beat inflation with a stick. And and then you look at like household debt and government debt and corporate debt, and you're like, well, I mean, how tough can you really get? So speaking of, Scotiabank now, who we've kind of dogpiled on throughout the beginning of the year. This is the beginning of the year, right? They called for 8 rate hikes. I think they've upped it to 9. You guys all know my view anyway has been 3 to 4. But you go 8 to 9, they're now calling for 75 to 100 basis point increase at the next BOC meeting. They're saying that there should be a decent probability of that happening because it's like the right thing to do. What I will say is if we get to, just keep in mind that Scotia is also saying house prices aren't going to correct. So, I mean, either their rate hike forecast is wrong or their house price forecast is wrong, and perhaps both, because all I can tell you is from a housing perspective, house prices are already declining, which we've talked about in the show before, but we're seeing that more predominantly in large parts of Ontario and Greater Vancouver, the two most important markets to policymakers. So you're already seeing price declines, and we've only raised rates by 75 basis points. So if we're going to get in another 225 basis points, I guess this year is what they need. Keep in mind that for clarification for you guys, again, to get into the weeds of the housing market here. So we've talked about this before, where if you're on a variable rate mortgage, 4 out of the 5 big Canadian banks, Scotia is the only one that doesn't have this product, but most Canadian banks, if you go directly through them, is they have what's called a variable rate mortgage with a fixed payment. So even if the Bank of Canada raises rates, 100, 150 basis points, like your mortgage payment will stay the same. You'll pay less towards your principal, you'll pay more towards your interest. Once you start, if you get basically a 300 basis point increase in the BOC's overnight rate, right? That changes your prime rate by 300 basis points. That then changes your variable. There is a trigger on these fixed rate mortgages. If that makes sense, right? So like the payment stays the same, but at some point you start getting to this negative amortization. Like if the Bank of Canada was to raise like say 400 basis points, like the bank becomes a negative amortizing mortgage. So there actually is a rate reset. And I can actually tell you guys what mine is, just for everybody's sake here. So my rate right now, my variable rate is 1.2%. It says there's a trigger here that if that rate goes to 4.5%, which would be roughly like basically about 300 basis point increase, roughly. That will actually trigger a reset and a new amortization schedule. So I'd be fine. But I mean, think about the vast majority of Canadians here that like you're just going to reset like a huge chunk of these variable mortgages. Like I just don't think people are actually thinking this through, and the ability of like households and like the systemic risk that would then create. And just to give one more sort of clarification here on the variable rate mortgages, we do have a data point on that, which is as of right now. So variable rate mortgages as a share of monthly mortgages issued. So we've been hovering around 55% roughly. So 55% of all new mortgages being issued or created over the past year and a half have been variable mortgages. So you basically, since the pandemic, right, the BOC cut rates to zero and everyone just piled into variable mortgages.
So Steve, I have a question for you, Steve. So I know with your example, the variable rate has to go up to 4%, but everyone isn't on that same scale. But what you're saying is basically if overnight rates go up, say 250, so 2.5% from current levels, am I hearing you right that there's a probability that a lot of variable rate mortgages are going to have a reset amortization schedule?
Yeah, there would be a decent.
That's like a guess. Do you know what I mean? Yeah.
Yeah, there would be a decent chunk for sure that would have to reset. And then you also have to think about what about all the people that are now like coming off of their mortgages and they have to go and renew, right? Like you're subject basically every mortgage in Canada resets or renews every 5 years, right? So, I mean, 5 years ago, the variable was probably 2.5. I mean, if we get what the Scotiabank is calling your variable is probably going to be 3.5 to 4% by the end of the year. So, yeah, you'd be
debt levels are 20% higher, right? Or debt levels are much higher.
I mean, yeah, I don't know. Rich, you probably got better data on this, but I was chatting with my buddy, Ben Rabideau, who runs the research firm in Canada. But he was saying he has through his models, he's saying Canadian household debt servicing ratios will hit record highs in Q1 of next year.
Yeah, I mean, that's not very, that's actually not that difficult, right? Just to give you, just to provide some context, and I'll include this chart for those on YouTube, which is Canada's household debt service ratio is 13.8%. So what is the debt service ratio? It's the portion of household disposable income required to meet debt obligations. Seems straightforward enough. And the problem is that ratio has been basically flat for almost 10 years or so. It's been hovering just under 14%. So what does that mean? The trick about that, though, is that the interest component has been steadily declining. That makes sense too, right? If you have interest rates fall, then naturally your interest component has been steadily declining along with it. But the problem is that the total debt relative to GDP, relative to disposable income, relative just in absolute terms, has been climbing higher and higher and higher and higher. And so that's the thing with leverage, right? It's a lever. And so as you get further and further out that, out and further out that branch, every little, tremor reverberates, it levers, obviously, the exposure and, the gains that you may get from a return on equity perspective, but also the pain that you might feel if you can't service your debt, or if you want to service your debt, but you have to forego spending on other discretionary or non-discretionary items in your consumption basket. And so I've never done the math to that degree with what you're referencing, but I can just tell you very easily, if you add just the way that the math is set up, if another 200 basis points basically on the interest, and you're in a world of hurt, really. I think that's the upshot.
I think the last time the debt servicing ratio there crept up was in 2018, right? And that was when we basically slipped into a mini recession / housing slump, et cetera, et cetera.
Yeah, that's exactly right. So I think it was at 15% in 2018, and then obviously it collapsed. But that's a function of a bunch of other different things. But the sometimes you have to sort of ignore those deep troughs and just sort of look at the trend, and the trend of the total number has been steady at 14%, and the trend of the interest component has been declining. That interest number just starts to get higher and higher. It's trouble. So
yeah, I mean, that kind of brings me to my next question, and maybe this is for Keith here, but so I'm kind of you kind of look at all these scenarios playing out, and we've talked about a financial event playing out, and I think without a doubt, at least in Canada, that financial event would be a severe downturn in housing and a household balance sheet recession. In terms of if these higher rates really do materialize, which they already are on the path to doing so. What about And then we can talk about the Canadian government. Obviously, we've blown massive deficits and didn't lock in a lot of that debt over long term. So, like, the amount of interest payments that they're going to have to pay if, again, Scotia's right and we get 300 basis points of rate increases, like the fiscal position of the Canadian government looks like a train wreck. But I think you can also make a similar argument for the US, right? I mean, I think US government debt to GDP is at 130%, which typically
depends how you calculate it, but it's a lot, and it's up there.
Yeah, and I think there's like that. I mean, there's that research out there from, I think it's Hirschman Capital, which is like every sovereign nation with public debt north of 110% of GDP is always defaulted, or 84 to 85 have defaulted or something. Keith, do you see like a scenario playing out as a possibility, and like maybe what the probability event is of like, okay, the Fed starts raising rates, they get 50, 75, 100 basis points in rate hikes, something kind of blows up and they're almost like forced back into like QE, even though you've got inflation still potentially elevated. Like you're basically forced to do QE in like an inflationary spike.
Yeah,
I know,
that's
sorry, just to add to that, because like, I mean, maybe this is an add-on to that question, which is like, I mean, isn't that kind of what the BOJ is doing right now? Bank of Japan.
The BOJ, they're not raising rates, but that is my expectation for what's going to happen, specifically in Europe with the ECB. So they're talking about maybe raising rates, but they could be the central bank that raises overnight rates, but then they'll keep other rates where they are to sort of offset them. But then they'll actually increase QE. I can totally see them doing that, and that's because the banking system is really insolvent over there. They never did write off the bad loans from the 0809 crisis. So anyone listening who they're a good investor and they look at book value for the European banks, say, oh, wow, that's a great value compared to the Canadian and American banks. It just means the book value is wrong. And everyone in the world, we all know this. And for anyone who disputes this, I always say to them, name one foreign investor who's injected capital, equity capital, into any Eurozone bank over the last 15 years. And I say, take as long as you want to come up to find the answer, because it hasn't happened. But that's the scenario I see playing out, Steve. And I think that the central banks, they'll continue to hike rates until something goes, something will break here. So again, with the Bank of Canada, I know that the rates that you were passing out earlier was, I think, Scotiabank's expectations, but right now the market is now implying that there's going to be another 50 basis point hike on the June 1st meeting. And I think the Loonie Hour just moved the market, because as we were talking, the implied rate went from 53 basis points up to 58. It literally just blinked as Steve was talking. So you're a market mover today, which is pretty good. Boom. I think though the one thing we're talking about, maybe like, is there an event out there that's going to cause something to go off sides? But it's already happening. And so like in the Canadian bond market right now, the long-term Canadian bond, like the 10-year bond, and there are fund, like the biggest bond ETF in Canada is based on this. And so that's down about 17.5% since the high in mid-2020. And we're down like 11%, 12% year to date. I mean, that is crushing the soul out of investors. And for those of us who were around then, but in 1994, that's the last time really that, central banks started, shocking the market. So I was working back then. And so the US, the Federal Reserve, they started raising rates aggressively. And they call it the bond market massacre. So look it up in 94, but it just crushed everyone. And that exact same market experience is happening right now. So, I talked about this or ranted on it last time, maybe even lectured really. But again, bond investors are getting screwed right now. So the question is, if you're the Bank of Canada or the Fed or anyone else, that, hey, if you continue on this cycle, you're going to make the pain even more profound. And at some point then, people chime, hey, when do we buy this? Is there an opportunity to buy? Because you always want to buy low and sell high and everything. But most bond investors will bail. They could end up, getting sold other strategies, which inherently have even more risk, like equity markets and preferred shares and stuff like that. So again, like you could have the most conservative investors in the world right now. They're walking straight on this double whammy. So again, like it's messy out there. It's incredibly messy. And if the economy starts to roll over again, which I suspect will happen later on this year, again, it's a pretty toxic mix out there for conservative investors.
Yeah, I mean, Rich, I don't know if you have any chime in thoughts there. Just to Keith's point there. I mean, he always talks like, reversing course when the economy goes in the dumps. I mean, I always just look at it from my housing market perspective, because I know in Canada that's roughly 20% of GDP, and so when I see housing activity rolling over and prices coming off, I just go, okay, well, probably not that much longer till we start seeing that in economic numbers. I mean, maybe that's another 6 or 7 months from now, but that's how I always sort of look at things from a bigger macro perspective. But Rich, I'd love to hear your thoughts.
So I think that what you guys have described, I think, Keith, you've laid out a path, and Steve, you've laid out a path, and that's the path I think that's going to happen. And the way that, if you want to impress your friends at the bar, what it's called, or a girl or a boy, you say it's called financial repression. I mean, that's really what the world we are entering in is.
Whoa. This is how you impress a date? Hey, I'm Richard Diaz with Global Macro Consulting.
Did you know we're in a financial repression?
I want to buy you a drink and talk about financial repression. Does that line work? Does that work?
Sadly, that's never worked.
Still a virgin.
But anyways, one can hope. Anyway, so that's what it is. That's the world we're living, where where central bankers basically don't want to let interest rates rise. And it's happened before. We've touched on it before. Between 1946 and 1962, basically you had after World War II, rather, there was no, the Fed was less important, let's just say. But what they did was they kept interest rates much, much lower than inflation for a long, long time. And that it's an important sort of lesson, right? Because if you look at the real return on bonds, it was disaster. You lost an incredible amount of money. I can't exactly isolate. I can't remember exactly which years, but there was a time, you lost a lot of money in real terms. And then the other thing that's really important to remember is that in real terms, equities also did really, really bad during that time. There was, forgive me, I'm a little tired this morning. Dropped my mom at the airport, so I can't remember exact dates, but there was like basically a 20 or 15 year period, or sorry, a 10 or 15 year period where basically you had, in real terms, your equity market returned basically nothing, or it was maybe 2 or 3% over that spread. And so that's where, for me, when I talk to my clients, and when I write, sector selection, country rotations become so important. But the upshot really is that we're in an era of financial repression. I don't see that going away anytime soon, Steve.
Well, yeah, that's a good point, because it's like everyone's like, you said rates couldn't go up, and it's like, and then you're like, oh my god, guys, like the thesis is still intact, which is like inflation's at 7, the BOC rate is at 1 right now. Hello.
That's exactly right. That's exactly it. Whether or not it's, sorry, I'm repeating what you're saying, but just if they raised rates by another 100 basis points tomorrow, it would still be deeply negative. And I'm not sure at all that would help the return on your bonds. And I really don't think the equity market would like it. I'm sure, as Keith will remind us, that cycles are killed or murdered by the Fed. But I don't know. Sorry, I think that's a really good point.
It ultimately just comes back down to Keith. Yeah, it's ultimately what it is. Let's just call a spade a spade. It's a sovereign debt bubble. Like, it is what it is, and so you really can't have real rates going positive again. Maybe you can for a brief period of time, but it seems like every time real rates run positive, we end up in some sort of financial crisis. So Keith, I don't know, you're going to chime in there.
Yeah, two things. So again, just to reiterate, I suspect there are conversations crush the economy. Maybe not crush it, but to bring it down. So again, don't be shocked if that happens. I just want to share with everyone. There's a really good piece that I've bookmarked and read it a few times now. It's from the website bankunderground.co.uk. So Rich, that's for all the Brits out there, Rich.
Is this like a conspiracy theory website?
No. It's the blog written by the Bank of England, right, Keith?
Correct. Yeah.
Okay.
It's a really cool article. Just do a search on it. And the title of it is Venetians, Volcker, and Value at Risk, 8 Centuries of Bond Market Reversals. So this was written back in 2017. And it does a really good job of showing how, again, 2017, you're looking at like 4 or 5 years ago, how low rates were then. And they were never, ever at that level in the history. This goes back to the 12th century. This is the Bank of England, right? There were all lots of stuff, information. But again, it's just suggesting that at that level, investors should expect a pretty big reversal. And then they also go through a lot of details on what happens at other reversals. So like they talk about the period you were talking about earlier, Rich, there, I think late 60s. By the way, like 66 to 82 was this horrible market for equities and the bond market.
Yeah,
so
that's exactly equities. That's what I was talking about. That's the one.
Yeah. So for that period, like equities had these whipsaws, like up 50, down 40, up 30, down 60. It was, and remember, it's pretty bad back then. But just to share with everyone that if you want to read a really cool article and then really impress your friend at the pub instead of with financial repression stories, this could help you, Rich. This could really help you. Again, Venetians, Volcker, and Value at Risk, 8 Centuries of Bond Market Reversals. Now that I read it out, I think
we'll put it in the comments. We'll put in the link below, right?
Maybe financial repression is a better story. That one sounds snoozy as well. By the way, are we going to have a Velcro suit in Vancouver?
We should. $30.
Definitely
You get to strap on the Velcro suit and run into the wall
with a big rubber band, right? Just to pull someone back and let them go. I'm not putting on the Velcro suit again. I did it once.
What's Rich's line there? Did you know the BOJ owns 60% of the Japanese government bond market?
Okay, BOJ. We need to talk about Japan next, guys. I remember. I know we introduced this maybe 3 episodes ago.
Yeah, I think it was a couple episodes ago, but it's continuing, which is just to frame it up for you guys here is I believe it's the US dollar against the Japanese yen there is at a 20-year high for the US dollar against the yen. So the yen is getting crushed from a currency perspective, Keith.
Yeah, the yen is getting mullered, and for a lot of people who don't know what mullered means, it just means that you're getting crushed. I used it in a tweet and a phone conversation this week, and
Big in Halifax.
They're both like, "What the hell is mullered?" I'm like, "Well, you're getting mullered, right? It's not good." So the yen is getting mullered here. And so the real interesting thing with the Bank of Japan, they're no different than the Fed and the Canadians a couple of years ago and everyone else. They're doing QE, but Japan has this unusual economy where domestic savings is enough to fund all their debt borrowings. So they don't need foreign investors, to walk in. And all that is demographic driven, and that's now rolled over. Now they do need foreign investors coming in at the margin to buy the debt. Of course, they're issuing more and more debt, so the Bank of Japan is buying more and more debt all the time. But what's happening now, they're starting to get leaks in the bond market. So where bond yields all around the world have started to shoot up, as we talked about, Canadian bond investors just got mullered over the last 18 months. See, everyone's going to use the word. See, Rich, mullered is a better word to use on your date than
I'll stick with financial repression. Thank you.
Okay. So what's happening now in Japan, there were signs that the bond market was about to go out of control. And if that would happen in Japan, you would have enormous losses for the banks and the pension funds and insurance companies over there, because they're just stuffed to the gills with bonds. That's what they are. So whereas quantitative easing, Yeah, crush the soul out of free markets, capitalism, no more. But instead, what the Bank of Japan has done, instead of saying, we're going to spend 50 billion a month on quantitative easing, they simply said, we're going to spend an unlimited amount of money to make sure the yield on the 10-year Japanese government bond does not exceed 0.25%. End of story. They drew the line in the sand. They said, you don't believe us, test us. So the relief valve from that comes from the currency, right? So now people start thinking, wow, okay, I don't have to sell my bond now to run. I can now sell my bond at this inflated price because the Bank of Japan just backed it. Now I'm going to get out of Japan entirely. So I sell my Japanese bond, I sell the yen, buy dollars or whatever else is out there. And so the yen has been, it's been on this steady decline. So now that, everyone in all the guys in my network are saying, okay, at which point has it been too much pain for the Japanese with the currency? Because if they then try to block the currency, then by default, the bond market goes. So they're in a real bind over there. And, I know for years everyone said, you never bet against Japan. It's the widowmaker trade and all that stuff. But things have clearly changed. We're now in a synchronized global financial situation, whereas before it was never synchronized around the world. So so that could be the event. So I've always said that for the Canadian economy to experience a stressful moment, it's going to come from outside of Canada. And I've always thought it would be the Europeans because that's just a gong show over there. Maybe it's Japan. I've always thought the Japanese would be the second last to experience a severe crisis, but maybe they're the ones, that is the igniter for it. So again, I just suggest to everyone, read up on that bond article that we just talked about, follow up on Japan and stuff like that, but just recognize that market movements in Canada are significantly influenced by events outside of Canada. And that's where we are with it. I got one more thing. I know you guys are itching to say something, but boy, the Bank of Canada just, what they say? You got let the hits keep on coming. Is that what they say? By the way, I need a haircut. I feel like Wolfman Jack, right? You guys don't know Wolfman Jack.
Who's that?
The guy's from the 60s, I think.
Some of the listeners will, but let the hits keep coming or rolling. They say. So the Bank of Canada, they put out a study. Remember, this is Bank of Canada, not the Loonie Hour. But they put out a study that said the majority of Bitcoin investors have very low financial knowledge or
That's
something.
Me, baby.
To that effect.
That's me too, baby.
Which is kind of ironic, right? So here's the Bank of Canada. I mean, they're getting mullered, of course, for their reaction instead of being proactive to stuff. So who has lower, financial knowledge? Is it the Bitcoin guys right now or the Bank of Canada guys? I think it's the Bank of Canada guys right now. But again, the Bank of Canada, here they are now, they're trying to, I think it's like the American political side, right? They're trying to get a deflection here, poke a fight with somebody else. So anyway, they're going to attract the attention of what do you guys do with your eyes? Why do you do that anyway?
Laser eyes, baby.
Why is that?
I don't know. Just what the Bitcoin crypto community does. I have no idea. I just did it because I think it's hilarious. But
you sound like a follower.
Tom Brady did it. Tom Brady did it. Yeah, the laser real
eyes.
Tom Brady.
Yeah. He's lost more Super Bowl games than anyone else in history.
Oh,
wow.
geez.
Here we go.
Thank you for that. That's a pretty bad record.
Speaking of the Bank of Canada and financial literacy, I mean, let's just talk about their track record over the past 24 months, which is inflation's transitory, wrong. Housing pricing, just pent up demand, wrong. And now they're saying, we can just raise rates to fight inflation because households can handle higher rates because everyone's got a mortgage stress test and house prices will remain elevated. No change. They're going to be wrong there again. So anyone that actually believes these guys is like a propaganda machine. And I think the propaganda machine is running again, saying, anyone that invests in Bitcoin is an idiot. Because, hey, let's call a spade a spade. Central bank digital currency is coming. And I think that Bitcoin is essentially a competition for that, right? It's like I mean, I like to call it basically like the digital gold, right? And it's like, those people that are like, let's go back to the gold standard. I mean, like that competes with like fiat currencies. So just keep that in mind when you're reading the Global Mail or the CBC News. Like, a lot of this is just propaganda.
There's definitely a hate on for Bitcoin, and I think it sort of makes me want to hold on to it even more. I don't know. I guess I'm just too much of a contrarian, but I wanted to correct Keith, if I may. You said that all the yields, global yields are falling. There's one country that's pretty big deal that's
rising,
yields,
not falling.
Sorry. Fuck, I screwed up.
So Rich, when the bond market goes, when the bond market goes down, the yield goes up.
Wait, I have something to say that's important. And I think I want you to touch on this actually, which is you were saying that all the bond yields were rising. And I said there was one country whose bond yields are falling, and it's China's. And we said that we were going to touch on that, which was that I think in Shanghai, I think we mentioned it briefly last time, that they're locked down. I mean, there's this great picture going on Twitter about all the boats that are parked off the coast of Shanghai, and it just looks like a Jackson Pollock Jackson Pollock kind of what's it called, modern art masterpiece, and it's just these different colors and these arrows, but really it's thousands of boats that are basically parked because China is convinced that they can control the coronavirus.
That's like
amazing.
Pure insanity. I actually have a client in Shanghai. He's moving back here. He's Canadian, so everyone relax. He's moving back, and so it was chatting with him. I was like, "Oh, how's it going over there?" And he's like, "Well, the food shortage stuff." He says it's a little bit overblown by like Western media, but he's like the quarantine camps. He's like, those are like insane. He's like, "Oh, they're legit and they are terrifying. Like they're overrun." And he's like, so he's telling me that like someone will test positive for COVID like 3 days ago, and like there's no room for them at these quarantine camps. So like once there's room, they come and grab you out of your room like 3 or 4 days later. It's nuts, man. Like, I mean, I don't blame people for wanting to get out of that country and park money into Canadian housing market, because it's like, geez, like it's insane.
Yeah, I mean, there's some. I mean, it's because you laugh or else you cry. I mean, there's some horrible stories about that. That people like babies basically being taken away from their mothers because they have positive COVID tests. Like, I mean, infants. Excuse me. I mean, there's some pretty nasty stuff there.
Aren't they like beating dogs that have like COVID and stuff? Like,
oh, they were there at one point. I know in Hong Kong they were killing, I think, guinea pigs or something. They culled a bunch of animals. I mean, mercifully, I think Canada's sort of stepped off the gas for that insanity, and I think we've just realized that it's got to burn through our economy before long, and we're not really going to be able to control it. But the reason I bring up the Shanghai thing is just because it relates obviously to growth, and relates to inflation, and as sanguine as I've been about sort of the supply chain constraints, I think it's just something that's definitely going to that might get worse actually before it gets better, which is something that sort of caught me off guard. Speaking of things that you got wrong, I thought the supply chain was going to get better over the last 6 months.
Well, it's a mess over there. I think I think that's a good way to wrap it up here. Basically, let's see how policymakers react and digest to inflation and how far rates will go, because I think this is really gearing up to be an absolute shit show. There is no polite way of putting it. And as always, we appreciate your guys' support. Like I said, go check out the Eventbrite page. We'll have that set up on all our social media platforms. $30 a ticket. We'd love to see you in Vancouver. It's gonna be a blast. Like I said, we'll do sort of a live pod for the week, so you get sort of early access to that, obviously. And we'll just have some drinks and chat markets, and be great to shake some hands here and see some faces. And like I said, we continue to appreciate the support from the Loonie Hour, growing the audience. Like we said, just share this episode with one person. And as always, we'll see you next week.